guys, Outhenticfx here. Today I'll be speaking about smart money trading versus retail trading, basically giving you the examples of what they do and how this is bad for the retail people, and changing your guys' mindset and shift into smart money institutional trading, which is our trading style, right? So we all know that when we get into Forex, everyone teaches us that support and resistance is key. The more a support level is tested, the stronger it gets, which is actually very false. The stronger or more times a level is tested is the weaker it gets. That's where you'll see price channeling up to that support or resistance multiple times, people selling, collecting orders, and then for there, eventually it either breaks up to the upside or to the downside, faking out multiple people and taking stop losses, right? So that all leads to retail liquidity grabs, right? So our trading style is based on smart money, supply and demand, which we always look for fresh and untested levels within our supply and demand zones. We target retail stop losses. So usually when the retail traders get kicked out, that's when we get in as smart money traders, right? We trade based off imbalance, which is also known as IPA, insufficient price action. And we also use institutional candles only. We don't use evening stars, dojis, all these fancy names for candlesticks. So we will get into the strategy later, but this is basically me showing you why our trading style is going to be much more simple compared to the retail method, right? Because we all know that the market either moves up or down, so we need to always be ahead and use the bank's momentum, the central banks who control the market. We need to use that momentum to best suit us, because the only way we are going to be profitable is if we trade with the banks, right? So supply and demand is actually based on bullish consolidation and bearish consolidation blocks. Usually what you'll see before a supply is created is a consolidation at the highs of price, and then from there you'll see large body candles to the downside, with the wicks, obviously large body candles to the downside, and then from there a return to that supply zone. So supply zones can also be used as resistance. I will go into depth on that part. And demand vice versa. Demand zones a bullish consolidation block which is created on the low of price. So usually what you'll see is price consolidating like this, price consolidating like that, sorry for that. And then from there, suddenly a large push to the upside. Then from there, a return into that demand zone, which the banks will obviously mitigate any imbalance that was left, or IPA, within this area, and then to continue pushing price up. Vice versa with the supply. Let me just re-explain that one quickly. From the highs, you'll see a nice consolidation in the highs, creating equal highs and equal lows. Obviously, we know retail will be selling at double tops and buying at double bottoms. The banks will then kick people out at this third push here. Once they kick people out, then from there create that large expansion, taking out the stop losses of those who bought at this double bottom. Once you see that large bearish push to the downside, price will return to that supply zone and then continue in its way. So we will be getting into the juicy stuff later. This is just a video for me to show you the difference between smart money trading and retail trading, right? So let's get into the charts and then see how we can use the charts to show us why retail trading is dead and why smart money trading is the new way of trading. So look at this. So I'm going to add support and resistance to this chart and then show you how support and resistance is very tricky when it comes to trading retail. And then I'm going to show you how we trade supply and demand real quick. Okay, cool. So obviously we are taught to have our resistance at the highs multiple touches. So notice here we have a rejection, price came down, came there, rejected, came down, came there, rejected, came down, right? So this is a double top. This is usually where retails are selling. Obviously now the banks will give price that momentum to the downside, and then from there build price up. When people get here, can you see they start selling again, they get kicked out, and they sell the breakout and they buy the breakout, on this push to get kicked out again, and then price then goes up. So it's always a mess when it comes to retail trading. Look at, for example, here, support. Price comes here, hits this level, you buy, price goes up, comes back down to this level, you buy again because you bought on this double bottom, and then the banks kick you out all the time. Price then comes up, creates a support here, pushes up to this level. You know the rule, support turned into resistance. Look how many people got manipulated on this doji candle. A lot of people sold at this point, and then what did the banks do? Push price up, kicked everyone else who was holding sells, and then from there brought price down again. You see, so it's always a manipulation thing with the banks. And then from there, once price gave us the second touch of this resistance, it brought price down. So now people are buying at this double top, so eventually at this double bottom, so eventually the market has to come down, kick everybody else out, and then continue in the direction that they want to take it into. So guys, retail trading is not the way. We are not retail traders at all. Let me just clear this and show you a nice example of a supply and demand zone, right? Nice example of a supply and demand zone. Let's look for it. Okay, over here, this is a beautiful example. We have a supply zone, which is a consolidation, right? Bullish consolidation. So we're just going to say accumulation, right? We put our accumulation tool over here. You can see we've got large body candles pushing up to the upside, and then price returns back into this area, right? So this is our demand zone. I'm going to write it here. Give me a second. Demand. I'll explain how we find demand zones later in the supply and demand zone section. So we've got our demand zone, just quick showing you how our strategy is much more simple compared to retail. Got our demand zone, price. This is our institutional candle here. I will explain what institutional candle is, how to spot them, etc. So once price, we have that break of structure over here to the left, bam, go here, break of structure top. We then see that this price returns here into our demand zone, and then that's our chance to get in with the banks at this point and then target the highs over here. Stop loss just above, just below, and then similar to a supply zone. Okay, let's look at a supply zone example, which is over here. We can clearly see bearish consolidation, right? We'll just put it as distribution for now. Bearish consolidation over here. Price is channeling down, creating lower lows and lower highs. We have that consolidation before price breaks structure to the left to create a new lower low. So we say BOS bottom, bam. This is our lower low now. Lower low. Lower low. Put that in red. And put that in here. This is our lower low. You will always see price respecting and coming back into the demand or supply zone. So in this case, this is our supply zone. You'll see price channeling up. Let's shift this right. Cool. Supply zone. Bam. Very simple, guys. We do not have our charts plotted with indicators, stochastics, all these fancy tools. We literally just trading a simple trading style and following the same rules. It's much more easier for us to trade with the banks than to trade within all this mess. Look at the wicks that are just here. Imagine how many people get faked out here. You see, look, people are buying, price came down, came here, they saw a double bottom, bought on this candle because they see, okay, cool, this candle is engulfing. So then from there, what happens? Zoop, banks kick everyone else out, and then comes to this level, and then from there they buy again, thinking that, okay, it's a double bottom at this level now. They hear it's a double bottom at this level now, they buy here. What happens then? The banks let them think that and then kick them out here at this move, consolidate. Imagine all this consolidation, guys. How stressful would you be in such a situation like this? So our strategy is very simple, guys. It's based on supply and demand, and also institutional candles, etc. I will get into that as time goes. So let's just stick to the basic formula, which is supply demand. Fresh untested levels in our supply and demand zones are much more stronger, guys, than levels of support and resistance which have been tested multiple times. We have clean charts. We only target retail stop losses, so that's when we get in. So when the retail traders are getting stopped out, the banks are giving us that move to get us successful and profitable long term, guys. So yeah, guys, that's for the video. I will be getting into the detail into the next video on risk management, institutional market structure, institutional market cycle, liquidity concepts, introduction to order blocks, etc., IPA. All the juicy stuff starts now. Thank you, guys.